Your retirement savings are currently being shredded by inflation. While most investors blindly hope for market gains, a specific subset of income focused portfolios generates predictable monthly cash flow regardless of stock prices. I'm going to walk you through the three distinct methods used to build this engine, starting with the exact dividend capture technique that converts a modest, static nest egg into a reliable year round paycheck that never hits a seasonal dry spell, a self sustaining engine. So sit back, keep your focus on the numbers, and let's get into the mechanics of monthly dividends. Getting paid every 30 days feels different than waiting for an annual check. It changes your relationship with the market because you aren't waiting for a price spike to sell. You're waiting for the clock to hit the next distribution date. Most companies in the S&P 500 pay dividends on a quarterly schedule. To get a monthly check, you have to be intentional. Here is how you do it. The easiest way to start is by looking at real estate investment trust or REITs. Think of these as companies that own, operate, or finance income producing real estate. By law, they have to distribute at least 90% of their taxable income to shareholders as dividends. Take a company like Realty Income. Their ticker symbol is O. They have literally trademarked the phrase, the monthly dividend company. They have delivered uninterrupted monthly dividends for over 600 consecutive months as of early 2024. Imagine owning a diversified portfolio of thousands of retail properties across the United States and Europe. Every time a pharmacy or a convenience store pays rent, a tiny slice of that ends up in your brokerage account. That is your first win. It is simple, it is automated, and it removes the guesswork of waiting for a quarterly cycle. But you shouldn't put all your eggs in one basket, even if that basket is high quality commercial real estate. You need to spread your risk across different sectors to ensure that check keeps coming regardless of what happens in the retail world. Now, let's talk about the level up. This is where you move from just buying individual stocks to optimizing your entire income stream through monthly dividend ETFs. An exchange traded fund, or ETF, allows you to buy a basket of hundreds of companies with a single ticker. If you only buy one or two stocks, you are vulnerable to a single management failure or a bad fiscal quarter. When you own a fund like the PFF or similar income focused funds, you are owning the entire sector. A study by the Vanguard Group found that investors who utilize diversified ETFs for their income stream show 60% less volatility than those who pick individual stocks. That is a massive difference in your mental peace of mind. When you lower volatility, you stop panic selling during market dips. You keep your position. You keep collecting the yield. You can mix and match these funds to cover different asset classes such as preferred stocks, high yield corporate bonds, and master limited partnerships. This is how you build a floor under your income. If one sector struggles, the others balance it out. If this is clicking for you and you're starting to see how these pieces fit together, consider hitting the subscribe button. I dive into these mechanics every single week, and I want to make sure you don't miss the next deep dive into income strategies. Stick around because we are heading into the best part now. All right, you asked for it, and here it is. The third method is what I call the dividend calendar optimization strategy. This is for the investor who wants to move beyond just buying what is popular and start engineering their cash flow. Instead of just hunting for monthly payers, you build your own three bucket portfolio. You take three sets of high quality quarterly dividend stocks that pay in different months. For example, one set pays in January, April, July, and October. The second set pays in February, May, August, and November. The third set pays in March, June, September, and December. When you combine these three, you have a consistent stream of income hitting your account every single month. Why is this superior to just buying monthly dividend stocks? Because monthly dividend payers are often limited to specific sectors like real estate or business development companies. By building your own calendar, you can include blue chip giants like Johnson & Johnson, Procter and Gamble, and Coca-Cola. These are some of the most stable companies on the planet. They don't typically pay monthly, but they have a track record of increasing their dividends for 50 years or more. This is known as dividend king status. You get the safety of the world's most stable corporations. You get the utility of a monthly paycheck. It sounds almost too simple, right? But the math is undeniable. A 2023 analysis by Morningstar showed that dividend growth stocks consistently outperform the broader market during inflationary periods. By layering these high quality quarterly payers, you are essentially creating a synthetic monthly bond that grows its payout every single year. Let that sink in for a second. You aren't just getting paid, you are getting a raise every single year. That is the secret to long term financial independence. You stop worrying about the stock price today and you start focusing on the dividend yield and the payout growth rate for tomorrow. If you apply these three levels, starting with stable rights, adding diversified ETFs for stability, and finally building your own dividend calendar with Dividend Kings. You will have created an income machine that is far more robust than what 99% of investors ever achieve. You are moving from being a spectator in the market to being an income architect. It takes time to set up the calendar. It takes research to pick the right stocks. But the result is a paycheck that doesn't depend on your boss or your hourly wage. So, there you go. Three distinct ways to master the monthly dividend game. And remember, the calendar strategy alone could end up paying you more in total return than any single monthly paying stock ever could, because you're tapping into the highest quality companies in the world. Take these steps one at a time. Start with your first monthly paying stock, watch how it hits your account, and then expand from there. If this helped you gain some clarity, share it with someone who is looking to move past just chasing growth and start building real income. Subscribe so you don't miss next week's breakdown, where I look at how to automate this entire process through a taxable brokerage account. Stay consistent, keep your eye on the yield, and I'll see you in the next one.